Hello everyone, welcome back to our third webinar of this series, this educational series. Now, today we will be talking about trading with indicators. This is the third webinar from the technical analysis module. After this one, we will be passing on to fundamental analysis and money management. Now, don't worry if you didn't have the chance to participate in the past webinars, the introduction one and the second one about candlestick patterns. If you like to see those webinars, because we will be talking about that information in this webinar, you just have to contact your account manager and ask him for the recording. They are available, from what I know, on the Forex Rally YouTube channel, so you can go there. You can go on YouTube, search Forex Rally, and you will have all the videos recorded. As I told you, introduction to technical analysis, and after that you have candlestick patterns, secrets of candlestick patterns. Both were done by me. Now, my name is Razvan Mihai. You already know me from the past webinars. As I told you, to be very short, I'm a certified financial technician. For those of you who do not know me yet, for the new, I can see that there are lots of new people in the webinar. So, my name is Razvan Mihai. I'm certified financial technician by FTA. I am also head of trading at Hazewell Asset Management. This is a closed asset management for VIP clients of Forex Rally, but some other brokerage houses. I am author of the upcoming book for experts, and I have gathered over 6 years of experience in TA and trading, and made over 1,000 hours of webinars, and I wrote about 10,000 technical and fundamental analysis in the last 4 years, not my full experience of 6 years, because first I began to trade, so I made myself an experience in trading. After that, in teaching and coaching technical analysis. This is my expertise, my domain. Now, let's go on and see the agenda for tonight. The first indicator that we will be talking about, it is the moving average. I've done a webinar in which I've already discussed about moving averages, and I've given 2 strategies based on moving averages, but I will say it again. I will discuss again about moving averages from the basic point of view this time. After that, we'll be going through to the next indicator. This is another trend following indicator, Bollinger Bands. We will be talking about some oscillators, MACD and RSI. Now, I would like you to know that these are only 4 indicators from a big number of indicators, technical indicators, which you could actually use on a trading platform. You can use many other oscillators, you can use many other trend following indicators, but now I'm giving you the basics for the most used indicators in the market at this moment. So the idea is that after this webinar, you could actually use the information from all the 3 webinars I've done, so that you can build yourself a strategy, which can be a simple strategy or which can actually be a complex strategy, which will give you high probability trading signals. So this is my idea for these webinars. I'll be giving you this information, and after that we will go pass on next now Thursday. On Thursday we'll be talking about how to read economic indicators. That's related to fundamental analysis. It is the basics, but it will help you very much. You'll see that there is a high difference between technical and fundamental, but combining them together will give you the best results. And the final webinar, the 5th webinar, will be about money management and how we can integrate the money management in our systems. Now, let's go on and talk about moving averages. Oh, by the way, if you have questions, you can use the questions tab, the questions window, and write to me, so I will be answering during this webinar. It's very important for us to get all the things that we are talking about in place and understand them very well. So let's go on and discuss a bit about moving averages. Moving averages are indicators that calculate the average price of an instrument over a specified number of periods. Is one of the most used technical indicators as trend following indicators. This is very important. And traders are using this tool to get into trades in the direction of the main trend or the direction of the current move. I'll show you what are the differences between entering on a trade and entering on a move depending on the moving average. And after that, I'll give you some examples on the graphic, on the charts. I will be using today, as well as I did for the past webinars, the Xstation platform, because it's very easy to use, very user-friendly. We have all the indicators there. We can customize it very fast. So I will just read to you the definitions of these indicators, but the most important thing is for you to see on the platforms on the platform how it works, what are the signals, and how we can use the indicator in our trading, day-to-day trading. Now, as I told you, moving average is an indicator that calculates the average price of an instrument. What do I mean by this? Well, let's say that we have a graphic, a chart, which starts from the price of $100. It goes up to 110, 107, it drops back to 107. After that, 120, 190, and so on to 125. It drops back to 117, 190, and from here we have actually a downtrend. We have an uptrend, so higher lows and higher highs is actually the definition for the uptrend, while lower lows and lower highs is the definition, is the way you will identify a trend, a downtrend, a falling trend. Now, let's say that we will have a moving average of 2 periods. This is a simple moving average. We will have to take two prices, the first two prices, 100 and 110, and make an average. As you can see, we have 105. If we take the next two prices, 110, 107, it's 108.5. So on, we can see that we have another series of prices. If we will take this series from here and overlay it over the chart, we will actually have something like this. So this is our moving average. But we had here only 2 periods for the moving average. We can use 5 periods. We can use 10 periods, 14, 20, 25, 30, and it can go up to, I don't know, I can give you a big example of 200, but you can get over 200. You can use 300 or 400, depending on what would you like to receive as a signal from that instrument, from that moving average. And now let me show you as a clear example on the chart. I have here the USD CHF, the Swiss franc with the US dollar chart for 50 minutes time frame. So as we can see, we have some lower highs and lower lows, and after that we have a bit of higher lows and higher highs. But here I like to consider it more two trends, because we have higher lows and after that higher highs, and the price made a low here, a high, and a lower low. So this is another trend if we take it like this. But let me put on the graphic, on the chart, a simple moving average. If the default, you'll see that not only in Xstation but in MetaTrader or many other trading platforms, which you will test, will have this 14 period moving average for simple exponential so on. There are several types of moving averages. We'll be talking now only of simple moving average. Now, we'll have the default one, 14. I'll leave it like this. So now it is set on the graphic. This is an overlay indicator because it overlays with the chart. And you can see that the moving average of 14 period actually smooths the trend, smooths the price, the evolution of the price. This is pretty steep here, but the moving average actually went up starting from here. Went down and after that went up. Now in theory, every time the moving average is below the price, it means that we have a rising trend. So this is a way of identifying the direction of the trend without using higher highs and higher lows or lower highs and lower lows. So an uptrend is defined as being the price above the moving average. The price is bigger than the moving average. This is how you identify an uptrend, while a downtrend, as it is here, the moving average is higher, is bigger than the price. This is what happened here. You see on this steep move, the moving average went above the price, and now it went below the price. The thing is, with this moving average, how we can trade, the easiest way we can trade based on a moving average like this one is to try to trade the breaks under or above the moving average. Let's say we have this move here, a down move. We know that, let me get out the auto. Great. Now, for example, we know that we are in a downtrend because we saw lower lows, lower highs, lower low, lower high. See, this is a succession of lower lows and lower highs. At this point here, or this point here, but this is the best one, when we have such a signal, the price breaks below the moving average, we can set a stop loss above this level, this latest high, and set a take profit around this low here, or we can go a bit lower than that around here. It would be pretty hard to know where the price will stop its fall, but we can take the previous low as a target. Now here we can, in the beginning, because it's very important for you to get to know the indicator, and you'll see that it is one of the most important rules in trading with indicators, to get to know very well the indicator that you are using. You can actually take each trade. So if the moving average was broken, you buy and set yourself a take profit, let's say at the local high. Stop loss underneath. We are not talking about money management here, we are just talking about how to practice your entries based on a moving average. You can take another entry here, sell, stop loss above, take profit. You can use the support given by the market here, or you could have tried to look for this low, but it was pretty far away, so the probability for the price to go all the way to here, it was pretty low. So it would be better if you have a local support to get that local support. About support and resistance, we talked in the first webinar of this series, so you will find it on our YouTube channel, or maybe your account manager has already given to you the recordings. Now let's get back to our charts here. Now by the way, a break, from me, a definition of the break is actually the candle closing below or above the price. So if I have an M15, this is the time frame. So one candle means that the price moved for 15 minutes. If the candle closes above the moving average, then I'll trade on buy and go on with the trade. If the candle breaks and closes below the moving average, then I'll sell and go with the trend. Now this is 14 moving average. Look what happened to it and the price. It is very close to the price. Let's say that we will take now to see a really good difference between this and another. I'll put in, let's say, a 100, no, too big, 110 moving average. I took this one, but we can have 100 or so. Let me change a bit the color. Good. Now, look what happened when we put on the graphic a 110 moving average. It is slower. In technical analysis, it is known to be a slower moving average. So the higher the periods, the bigger the number of the periods, the slower the moving average. You see now that the intersection of the price with the moving average is not that often like it was on 14. Now this 110 moving average gives me the direction of the trend, the main trend, while the 14th moving average gives me the direction of the next move. So you have down move, down move, up move, while on the 110 you have a downtrend formed by down, up, and so on and so forth. Let's say we will add another one, and I'll show you now a simple moving average of 200 periods, and you'll see that this is really interesting. If you'll put the 200, let me make it a bit thicker. Good. Now this is good. 200 moving average is very good. You can use the 200 moving average as a support or resistance because the 200 moving average works very good in technical analysis. You'll be hearing about this moving average on Bloomberg or on Reuters in their analysis on the TV or on their website. Technical analysts all over the world uses the 200 moving average, but this is actually used to define the main trend. You'll hear something like the 200-day moving average turned down or got over the price or got below the price. This means that they are expecting for a downtrend to continue or to come in place, or an uptrend depending on the direction of the moving average to change, and so on and so forth. So the idea is, if you are using a 200 moving average, as we have in an example, we have a very slow moving average and we are expecting to get into trades that will bring us more profits, but we will have to wait for some longer period of time. While if we want to trade on short and let's say medium term, but the correct definition is short and very short term, we will need to use faster moving averages like 14, 12, 10, 20, 21. These are moving averages that can help us define the moves, and we can trade based on these moving averages. We can actually make another strategy by combining a slow moving average with a fast moving average. Now, regarding this strategy I was telling you about, you will find some details on, I don't know if they uploaded on the YouTube channel, but ask your account manager to give you the recording. I know that I did a webinar special for the real clients of Forex Rally. It was done 2 or 3 weeks ago, so it's pretty new. Get your account manager to send you that recording, talk with him, and for sure something can be done there. Now, this is about it with moving averages. I told you, if you have questions, please tell me about them. I'll try to answer your questions, especially if they are related to our webinar theme from today. Now, let's go on and talk about Bollinger bands. Uh, I wrote here the definitions of Bollinger Bands. I'll tell you about it. Bollinger Band is actually a technical analysis tool invented by John Bollinger somewhere around 80s and evolved pretty much from that point. The idea of Bollinger Bands is that it can be used to measure the highness or lowness of the price relative to previous trades. It is also known to be a volatility indicator, and its purpose is to provide a relative definition of high and low. Now, this may sound a bit hard to understand, but if we are going back to our chart, and if we are going to set on these charts, let me take out this indicator from here. Now, I like to have Bollinger Bands. Okay, the default period is 2. The standard deviation. So this is actually behind this standard deviation. It's a very complex formula which uses this number of periods. Actually, the number of periods is here, but the number of deviation is here. We can set it 1, and let me show you what happens when we set it 1. When we set the standard deviation 1, the channel that it is created around the price, it's not that big and it doesn't actually help us very much. The idea of Bollinger Bands, from what I managed to understand while I was learning it, is that it offers you support and resistance for your evolution, for your price evolution. So now, what am I talking about? If we are using 1, it doesn't help. Let's get it to 2 and see what happens. The width of the channel now is a bit higher. Let's move it to 3. Now, from my experience with this indicator, the best customization of the Bollinger Bands up until now was 21 periods, and it doesn't depend on the time frame. Now we are having a 50 minutes chart, 20 with deviations of 3. What happened? Did I delete it? So I'll go here with 21 and here with 3 and add it on the chart. So using 21 as your periods, this is the moving average. You'll have a moving average here. This is the middle of the channel, and this is a 21 period moving average. And after that, you have the standard deviation of 3. Now, how I really like trading with Bollinger Bands. I will combine it with the direction of the trend because it will give you a higher probability to enter a good trade if you are using it on the direction of the main trend and not against the trend. You'll see that you'll get some false signals. Of course, none of the indicators that I'm talking about in this webinar are giving 100% accuracy or are not 100% accurate. So you'll have to actually test them, combine them. Let's say we can combine moving average is what I'm going to do now with Bollinger Bands to get a better result. This is called filtering. So we are putting on the chart some filters, so we will get the best trading signals for the current market situation. So let me put a simple moving average of, let's say, 100, because I would like to see the main direction of the trend. In this case is actually down. So as we can see, the price broke under this one, the green line, or let me make it blue and thicker. Great. Now it's, I hope you guys can see it, and it's easy to observe. So the price went here under the 100 simple moving average. It retested it. Now at this retest, we can see that we had some very interesting candlestick patterns here. This is called the evening star, but I don't like this candle because it's very big, but I like the shadows. The big shadows from here tells me that there is a high pressure coming from the bears. So my idea of a trade here would be that if the minimum of this candle here will be broken, then I expect for the price to go and hit the lower boundary of this Bollinger. So the first signal is that the price drops under the 100 EMA. I know that the direction of the main trend now is down. I'm just waiting for something to happen around the Bollinger, the upper line of the Bollinger. Now I can see here pressure from the bears with these shadows, and I am expecting for the price to fall. Let me show you what happens here. So again, it was a range, the price dropped. Now look at this, look what's happening now. After a period of almost sideways movement, this was a bit sideways, the price started to go up, it break the 100 moving average. Now we have an uptrend. If we are thinking about the moving average definition, we have an uptrend, and the price is only around the halfway of the Bollinger. My expectations for this: first, I will need for the price to give me some signals. So I think that the Bollinger Bands will actually go up around here, around this moving average. The moving average will move a bit up. So let's say it will go around towards this level, 149.09 during tonight. And tomorrow I will expect for a candlestick pattern here to combine it with the moving average, with this area here, with this round level, with this lower line of the Bollinger Bands. So the thing is that now with indicators, because almost all the indicators that I know in technical analysis are lagging, so they are giving late signals. This means that you will not be able to enter on this low here, on this point of low, and exit here. So you'll need a period of time for it to confirm the change in the direction. This means that it is lagging, and almost all the indicators are actually lagging indicators and are pretty hard to follow. You need really good management, or you can fine tune them using other indicators, like I've told you about this moving average and the candlestick patterns. Now, candlestick patterns combined with technical indicators, it will give you some really high probability for the trading signals. I talked about candlestick patterns, as I told you earlier, on the second webinar of this series, and it is called Candlestick Trading Secrets. You will find it free on the Forex Rally YouTube channel. Now, getting back to our charts. This is Bollinger Bands. It is one of the most used technical indicators, but in complex strategies. Moving averages are easy to use, and you can create some basic or simple trading strategies, while for Bollinger Bands you need some experience, you need to test this indicator on different instruments, especially on those that you are trading, and you will need to fine-tune it, let's say changing the number of periods or maybe the number of deviations, or you can combine two Bollinger Bands. And let me show you this. This is as a bonus for you guys, because you've been here all the time, and I see that you are trying to learn, so I'm giving you this as a bonus. It wasn't in my schedule for tonight, so I'll make it short, but you'll really love it. A thing that I like when trading with Bollinger, let me delete all of these. I can use it simple, only one indicator, three deviations with 21 periods average, but I can add another one, another Bollinger Bands, and these, it will get very interesting. I'll use this time 2 standard deviations, not 3. Let me make it blue and increase a bit the thickness. Great. Now we have, in our case, 2 Bollinger Bands. The simplest way to trade inside these 2 Bollinger Bands is to wait for a reversal in this area here. So the area between the 2 standard deviation and the 3 standard deviation, up or down. So you either wait for a confirmation, let's say, like what happened here. This is actually a candlestick pattern. This is called piercing line. It wasn't in my presentation from last week. It isn't one of the most used candlestick patterns, but you can find it on the internet, or if you like, I can make it in a new webinar, but it's your call. You just need to tell your account manager what kind of webinars you like, and we'll be doing it at Forex Rally. Now, as I told you, piercing line here in this area, the price went up. Very nice, very smooth. We could have exited around this level here at the latest high. After that, here there is a nice range. As you can see, higher lows, lower highs. This is a range here. If the price would have broken, and it did break this, the stop loss would have went under this low here, and the take profit may be around this level of resistance, which was actually reached. As you can see, the price retraced, but it didn't touch our stop loss, and after that went all the way up here. Look what happened here. Range, broke the support, the price went down. Now here I would have chosen to exit around this support level here, and I would have set the stop loss around this level. Look what's happening with the price. It is falling. So our area around here can still be in place. If the price will stop, I think that it will find a pretty nice support around this 149.06. And this is actually, let me see, this is GBP/USD. Oh, and I really forgot about this one. We are on a 50-minute chart, but I'll show you on H1. So today I wrote an analysis on the Forex Rally website. It was a setup idea that if the price will manage to break, and I think I used their 30 minutes chart, yes, here. So if the price will manage to break this level, I think we can go and check. I thought that there is a high probability for it to reach this 149.59. It went above this. I entered a trade. My take profit was hit here, and now it is retracing, and I am expecting for the price to stop for a moment. I don't know what will happen after that, but I am expecting for it to stop around 149.10, and if it breaks 149.10 to go a little bit lower and test the round level of 149. So this is technical analysis based on the price action. I can use these indicators here to set support and resistance, but the easiest way is to use actually the evolution of the price, the past evolution of the price. Now, getting back to our indicators, so use the area between the standard deviation of 2 and standard deviation of 3 and find good signals given by the price action, like candlestick patterns, range, support, resistance, so on and so forth. So it doesn't matter if you are having the price falling inside this area here, the down area, then you are looking for buy signals, while if the price will go inside this area, then you will be looking for sell signals. Look what happened here. The price went all the way inside of this area up until here, and only after that it started to fall. Now here I don't really have a very good selling signal. I don't really have a very good candlestick pattern, so it would be better for me to stay out of a trade if I don't have good signals. Sometimes it's better to be patient, to wait for the market to give you something and trade that signal instead of trying to trade each and every signal that the market gives you. It doesn't matter if you use indicators or not. Now, as I told you, for moving averages, it is also applicable for this one. You just have to take it and test it. Test it as much as possible, trade on demo as much as possible, understand the indicator, and try to combine it with different other trading tools, or maybe you will get to understand and develop a strategy for your own, and you'll get some very good probability for your trading strategy. I'll teach you next time about fundamental, and one of the most important tools that a trader has is actually the money management, about which I will be talking on next Tuesdays from today in 1 week. So I'm expecting you guys to be there as well, since it will be the last webinar of this series, and after that we have a surprise for you, and I think you'll find out about this surprise starting tomorrow or the day after tomorrow. So keep your eyes on the Forex Rally website. Getting back to our presentation. Now, this is what I had to tell you about the Bollinger Bands. I'm trying to give you basic information. Now, the colors of the... Let me get back to our chart. Yes, the colors of the candlesticks actually tells you if the candle is a descending one or an ascending one. In this case, the red candles are descending candles. It means that the opening price for this candle was here, up here. The closing price was done here, but the price in these 30 minutes, because now a candle has 30 minutes, we are on a 30 minutes time frame, went all the way to here, all the way to this low. It reached 149.35 and closed at 149.48. So it is very important for you to understand these candles. As I told you, there is a special webinar already done for candlestick trading. I explained there what are candles, how are they drawn on the charts, on the platform. So I'd like to invite you to see that webinar. For sure you'll find it on the YouTube channel, and it will be easier, because now I will have to get back to the presentation, because we have two more indicators, MACD, and this is an oscillator now. It will be easy for you to understand, because as you already know the moving averages, this is actually called, the long name of MACD is moving average convergence divergence. It is actually an indicator based on two EMAs, two exponential moving averages. These are calculated a bit different than the simple ones, but they do pretty much the same thing. They indicate you the direction of the trend, or if the move actually gets around, turns from up to down. Now, it is created from the 12 periods EMA and 26 periods EMA. This is the default settings for the MACD. You can change these numbers here, but I advise you to start using it and test it with these default numbers, because during its development, these two 12 and 26 EMAs actually gave the best signals on the market, so they remained as default. But you can change them depending on the time frame and depending on the instrument that you are trading on. And a 9-period signal line. Now let me show you what is actually this MACD. It is an oscillator. It's medium level. It's actually 0, and it looks something. Oh, I did a boo-boo. I closed my presentation and I shouldn't have done that. Let me get back to it. Bollinger and MACD. Now, okay, everything got back in place. Let's go on the chart and see another chart. This time we have USD with the Japanese yen. On this chart we actually have MACD. this is how a MACD looks. So you have actually two moving averages on it. It looks like moving averages, but they're not really moving averages. And a zero line, which you can see here. And let me draw it for you. So zero, we can actually edit this line to be 0. And so you have two lines which looks actually as moving averages, and histogram. This is called a histogram. This is very important, but the trading signal that I will be talking about in this webinar is very, very, very simple. But first of all, I'd like to show you how this MACD is actually created. Now, if we are to put in a EMA, this is an exponential moving average of 12 and an exponential moving average of 26, increase, change the color, increase the thickness to see something different here. We will see something like this. Sorry about that, I'll just untick the auto. The 0 point, so when the slower moving average, which is the green one, the 26, gets under the faster one, it means that the trend is up. At this point, the MACD, this line here, actually passes above 0 level. So the cross point will always be the 0 level for this indicator. Now, as long as the price is going up, you will see that the divergence between the faster and the slower gets bigger. So as bigger the divergence gets, the higher this line will get. Now, this is the actual MACD, moving average convergence divergence. To this, it was added another average. This is a 9-period moving average. This period actually is calculated using the numbers out of the MACD. And the histogram from here, it is actually drawing the divergence between these two lines. So if we'll take the thickness from here, we will have a bar. If we take the thickness from here, we will see that it is actually a smaller bar around here. The thickness here is actually drawn as a higher bar here. Now, this can help you create a very complex strategy, trading strategies, to give you some good signals. And this MACD has lots of secrets that I can show you, but maybe in an advanced webinar. You first need to understand what it does and how it will help you in your trading on day-to-day basis. Now, the main thing is, if you have a zero pass of the MACD, you actually have an uptrend. This is your uptrend. So if the MACD goes above 0, you have an uptrend. This is a good signal. Now, the other signals that the MACD gives you is buying signals when the signal line, the red line from here, gets out of the MACD. So the 9-period signal line is actually lower now than the MACD. This is a buy signal. Now, in theory, when you see this cross and a confirmation with a closing candle, you will buy on the next trade, use the low to put a stop loss, and use price action like this resistance here to get out of the trade. Of course, you can buy here and wait for the opposite signal. The opposite signal would have come around here. So the signal line went out of the MACD and now is above. This is actually a sell signal, but it can also be as a negative signal for your buy trade. So if you went on buy here, you set the stop here and actually exit when you have this signal here. But the price continued to move up. You can see here, this is not a buy signal, because buying is, you will try to buy when the MACD is under, is below zero, and sell when the MACD is above zero. So you are expecting for the uptrend to change into a downtrend, while when he's below zero, you are expecting for the downtrend to be reversed into a uptrend. So these are very important while using this kind of indicator. Now, other good example was here. If you would have sold on this signal here, as you can see around here, you could have set a stop loss using a resistance, the local resistance, and went out. Let's say you would have used something else around here, or you would just have waited for the negative signal. But in this case, it could have been a lower profit. I usually work with that. When I'm setting a stop loss, I will tend to set the take profit at least 1.5 times the stop loss that I set. Let's say a clear example, if I will set a stop loss, if I am affording to lose $100 on a trade, I am expecting the market to give me back on my trade 150. So I'm trying to gain from my trade more than that than I could lose. So if I'm setting a stop of 50, then I'm expecting the market to give me 75. I'm risking something, but I want for the market to give me back something more. In this case, if I have 50% of winnings and losing, I will still be on profit because I'm expecting the market to give me some more. Now, even if I toss a coin, I already said this in the first webinar. Think about it. If you are going to toss a coin or throw a coin 100 times, what do you think the odds will be? Around 50-50. Statistics show that it will be 49 to 51, depending on which side is the above. It's above. So the above side will actually fall for 51% of the times, while the one from the below will be only 49%. So these are statistics. In this case, if I'm trading while tossing a coin each time, and I'm using this money management. This is I told you about this money management scheme of mine, but I'll be discussing it a bit more in our next webinars. So if I'm using this 1 to 1.5, believe me, the mathematics will show me that I'll be winning, and I'll be constantly winning. Good. Now this is the MACD. Buy when the MACD is under zero and the signal line will get out and will be lower than the MACD, and sell when the signal line will be above the MACD and the MACD is actually above zero. So this is a good example here. This is a good example here. It was another good example here. If we are going to look for other signals behind, we had here, this is not really good. When the MACD is keeping itself around zero, it's not very good because this is a sideways move. We are trying to trade in a trend because this is a trend indicator, and it helps us if we actually have a trend. Here would have been a very good example, also here, and so on and so forth. Now, because we have only 10 minutes left, I would like to show you the last indicator of this webinar, which is the RSI. So the RSI is one of my favorite oscillators. I know lots of things about RSI. I've traded with RSI. I've combined RSI with different trading instruments, or just use it by itself in my trading career. And believe me that it's one of my favorites. MACD, I like the MACD, but RSI is one of my favorite, and I still use this RSI in different strategies that I use on day-to-day trading, on a daily basis, or I combine it with, as I told you, with different other tools to make new strategies for different type of instruments. Now, the relative strength index, this is actually the long name of the RSI, is a banded oscillator, and the formula behind is a bit more complicated as for the MACD. The most important things that you should know is that it is usually used with the set of 70, 30 and the 50 level. Now instead of 0, the 50 level is actually the medium level for this oscillator. And the most important thing now for you to know about this, and the main signal, is that it gives you overbought and oversold markets. Now for this, let me give you an example. Let's say that I can usually run around 5 to 6 kilometers without having to stop. I know that it's not that much, but this is about what I can do right now. Now, maybe if I'll try some more, I can run, let's say, 7 kilometers. But if someone will push me to go above this 7, I will give lots of signals that my body will not last above 7, maybe 7.2, 7.5, but that's about it. And my body will show me that I'm over exposed, I'm very tired, so I will not be able to go on. This is what actually the RSI gives you. It shows you when the market is actually, let's say, exhausted, and it has a high probability for it to return, to reverse. So an up move to become a down move, and a down move to become an up move. And let me show you again on the platform, because the examples are actually the best way to learn. When I learned this, I didn't get a chance to see webinars or to go to seminars or workshops or whatsoever. There were not that many done at that period when I started learning about trading. So if I'm trading for 6 years, about 7 to 8 years ago, so I read books. I found some books and I read books, but the easiest way for me to understand how it works, it was to read, to have the chart. At that period, I didn't even have access to all these charts, live feed and so on, and trading platforms without paying for that trading platform. Now you just have to open a demo account and trade on it without no risk and try your strategy, make some money on that account, and after that you have the luxury to open a real account and invest using the strategy that you actually tested on the demo account. So I had to read and study these indicators on the charts that I had. Usually were static charts, but I was using pen, pencil, whatsoever, and try to find the signals, and after that try to paper trade based on the signals I had. Now, nowadays it's really easy to do this, and it's really easy to understand and apply. Now let me get back to our charts. Open another Euro USD, because we didn't discuss about it. This is the Euro USD chart, and I like to add an RSI indicator. Good, RSI. The default period for the RSI is actually 14, and I usually use it like this. If you go lower than 14, it will be pretty fast and it will give you lots of signals. If you go above 14, then you will have less signals but a bit more accurate. Let's leave it with 14 and see how we should trade based on the RSI. So I told you that there are two very important levels. Those are 70 and 30. Let me emphasize these levels here. So I'll go to 70 and duplicate this. You can duplicate it, just click on the line, hit control, stay on control, and after that drag and drop the other line. I'll put here 30. So see how easy it is to change everything on this platform. That's why I told you that it's very user friendly, and I really recommend to everybody who's in love with technical analysis. It's very easy to use. Now let me get back to our indicator. When the price goes above the 70 level, it means that the market, it is going in an overbought area. So I told you, it's like me running 7 kilometers. I'm already exhausted. I'm sure that in the next couple of 100 meters, I'll be falling, and I will not be able to continue. So this is what happens to the market. When the price goes above 70, it means that the market is overbought and a correction might start. This is what happened. And look at this. We are on a 50-minute chart and it was wonderful. Besides the fact that the indicator showed us an overbought of the market, we had here a shooting star. This is a reversal pattern given by candlesticks chart. Now, here I would have sold a next support and I'm expecting for the price to hit it. It's 105.18. It's not that far from the price, 20 pips from the current price. It can do that. So the price may be able to get back to 18. For me to be a bit sure, actually to have a higher probability for my target to be hit, I'll raise it 4 more pips, and instead of 18 I will have 22. Why? Because sometimes it happens that the price will not go right at that level, that support level. It will stop a couple of pips higher. So it's better for me to have a higher probability of success and just give 4 or 5 pips away from my trade, especially if I have a good risk reward, which we will be talking about in the last webinar on money management. Now, this is a sell signal. The sell signal given by the indicator is actually when the indicator, the RSI, falls back, and let me get that, falls back below 70. This is actually the selling signal. This means that you should sell. If you are trying to combine it with candlesticks, then you'll need two signals. This is a signal, and the confirmation was given by this candle here. It was really, really nice. Now here it was another example, and a very good example. So the price fell while the RSI got under 30. It means that the market this time is oversold. So it's like me being fresh, too fresh actually. But the market is being oversold here. It's pretty much the same thing. So it's rallied too much on the downside, and it is actually the time for it to reverse. At this point, sell and see what happens. So the selling signal was here on this candle. After this, buy here, put the stop loss under the latest low, and just go with the next resistance level, which it seems to be also this 18. So support, resistance, another target. It was a resistance here. Look at that. So in this case, instead of having 22 or 18, I would drop that to maybe 15. So if I'll take this down to 15, look at what happened. The price actually hit my target and it jumped back a bit, and only after that it broke and went above to hit another high. At this point, I'm waiting for the price to hit around 0.722 for the euro dollar. Look at this, the pressure is still down, and I believe that maybe in the next hour we will see the price hitting this level. Now, this is actually how you trade based on the RSI. You are waiting for the market to go overbought, in our case to go above 70 level, and after that let her get back under the 70 level to sell. Stop loss above the latest high, take profit out of the price action, and this is how you trade based only on the RSI. There are some other things that you can use while trading on indicators, especially oscillators. They are called divergences. Not like on the MACD, like moving average convergence divergence, but there are some secrets and tricks that actually gives a higher probability for your selling signal. Now, this will be talking in the next intermediate to advanced webinars, not in this series. This is pretty much what I wanted to tell you about RSI, and as I told you, it is very simple. using it in a basic level, it actually gives you high probability signals for your trades. Combine it with candlesticks, combine it with support resistance, or you can actually combine it with Bollinger, and that's a very interesting strategy. I have a strategy based on the combination of Bollinger with RSI, and it still gives me after a couple of years good signals on euro dollar, on oil. It doesn't matter if it is Brent or WTI, so very good signals. Maybe we'll be talking about that strategy soon. Now, there are some rules that I like to tell you about while trading with indicators. It is very important. I said it in the beginning of the webinar. I said it for the moving average. I said it for the Bollinger Bands. I didn't repeat it for the next two indicators, MACD and RSI. But it is very, very important for you to know the indicator, to test it, to trade on it, to trade on every signal, to see what signal is not that good, what signal is better for you, combine it with different time frames, combine it on different instruments. This is the way that you should work with indicators. You cannot actually take an indicator and expect it to work for you from the beginning and give you the highest probability ever. You have to fine tune it a bit to understand it, to know when to enter, to know when to exit. But this time spent here with me, and maybe you'll have some other questions, you can talk with your account managers, you can send me some emails at research@forexrally.trade. I have access to that email, so I'll be watching it. Now, the thing is, if you are practicing it, and especially you have the luxury to use it on demo, if you are practicing it, you'll get better results, and you'll have better results if trading on the real account. Now, this means that you are playing with probabilities and you are doing a smart trading and not just tossing the coin or gambling. Lots of people actually lose on this market because they are gambling or they are tossing the coin without knowing a bit of business. This is actually a business. This is actually a job. So if you want to be a trader, you can be a part-time trader or you can be a full-time trader and make money while staying home. But you need a strategy. You need some time to invest in this strategy. It's like actually being a dentist or being a doctor or being a lawyer. You need some time to learn that job and to learn everything you need to get that job. This is the same thing with trading, but there are lots of benefits behind this time spending in learning. The first thing is you have to invest in yourself some time. You have to invest in yourself some money to trade at least once on a real account to feel the emotions. And I'm telling you now, and I'll be telling you in all my webinars that I'll be doing for Forex Rally, that there is a high difference, big difference between trading on demo and trading on real accounts. And though that difference is actually coming from the emotions that you involve when trading real money. So my personal advice for you is try to trade at least one time on a real account, even though it's not that much a big amount of money. You don't have to put in a big amount of money, as small as possible, but you will see a big difference in trading demo and trading that little amount, even $1 if you want, $2, or I don't know what's the minimum. I think these guys have actually want 1,000 leverage, so you can put the minimum amount, $50, and trade with $10. You can actually enter a trade, a mini lot, a micro lot, actually 0.01, and you can actually feel the real thrill of the real account. If you don't handle that thrill, then it will be harder for you to make money on the market. So you should know it from the start. It's not for everybody. I'm telling you, it's not for everyone. But believe me that everyone can do it if they would just have the patience to learn and go through the basic stuff like trading on real accounts, seeing the emotion, knowing about indicators, not that much, the basics, knowing about money management, And if you wish, you can learn a bit of fundamental analysis and how to read the economic news, which I'll be talking about in the next webinar. Now, getting back to our second rule, create clear conditions for entering and exiting a trade. I told you, for each type of instrument, for each type of tool, for each type of indicator, you have some conditions. You need to respect those conditions while trading. If you are not respecting them, you are not getting from the market the right signals. You may enter the market too soon or too late. This is why you need to be patient. Wait for the right moment. Now, a trader which who actually lacks patience, it is actually a losing trader. So traders always have patience to see, to watch the market, to get the right signal at the right time. This is very important. Right signal at the right time. Now another rule, it is the last on my list but not least, don't combine too many indicators, else you'll have your chart looking like this. There are too many indicators. Lots of indicators on the same chart can give you different signals, and then you will not know what trade to make. Buy, sell, what am I doing now? Some of them are saying buy, like here we have moving averages saying buy and pivot points saying buy, and also the parabolics are, which is another trend following, saying buy, but the oscillators are saying, all of them are saying sell. What am I doing? What am I doing? So try to select for the beginning 2. After that you can go up to 3 or a maximum of 4 indicators in the same time on the chart, but 3 I think it's enough. Let's say 2 trend following and 1 oscillator, or 1 oscillator and 2 trend following. You combine it with candlestick patterns and that's pretty much enough. I usually trade and I have a high probability of success on my trades if I don't use any indicators or if I use one indicator. So now the thing is, these indicators can help you a lot, can improve your strategy, can give you better signals, can increase your probability of winning, but you need to know them. You need to be patient with them to wait for the right signals at the right time, and you don't really want to have your chart looking like that because you will not know what to do. So that is what I had to say about indicators for today. This is our webinar. Thank you for attending this Trading with Indicators webinar. As I said, my name is Razvan Mihai. I'll be waiting for you in the next webinar on Thursday, fundamental analysis, and after that on Tuesday we'll have money management and a surprise for you next week, and it will be, I believe, on Wednesday, and that will be a very interesting webinar. So that's about it. Have a good night and hope it was useful for you. You will be able to see the recording of this webinar tomorrow on the YouTube channel of Forex Rally. I'll be giving them the recording as soon as it will finish to convert this night tonight, and you'll have access to it starting for tomorrow midday, I believe. So have a good night and thank you for being here with me.